Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, June 19th, 2018. In this video, I wanted to do an update on the aerospace and defense sector. We have an active trade on right now, that's ITA, and I did a video recently. I've actually updated the defense stocks several times this year, and I did an extensive video on May 1st, so this is a follow-up to that video. Now, there's three takeaways from this video. I believe there's something in here for everybody, bulls, bears alike. If you are, well, first and foremost, I think these are shorting ops. That's why we have ITA on, and I pointed out, I highlighted some of the individual stocks within the aerospace and defense sector, and even gave you some targets on some of those. We'll touch on just some of the top components today. I'm not going to go too far in depth here, again, because this is a refresher or an update to that May 1st video. The other takeaway is for those of you who do not short stocks, um, or you're bullish on the market at this time, bullish on this sector, or maybe you own some of these. The takeaway here is I'm going to go over these charts and show you the key levels to watch, so you don't give back too many profits if I am correct on this sector. And then finally, and this really kind of translates over to the broad market as well. I'm going to focus on this sector, and we'll start here with the chart of the aerospace and defense sector that goes back into the 80s and try to impress just how powerful a bear market is and how much potential there is, either as if you have the gumption to, short, get a good entry, maybe build a position, add to it, and then hold throughout there. It's like investing in reverse. So in other words, trend trading on the short side, capture some of these trends. And then again, if you're bullish and you're, bought into that whole buy and hold forever mentality, well, by the time the next bear market in the aerospace and defense sector is over, my guess is we're looking at something along the lines of probably 50% or more give back. Where I come up with that number, let's just take a look here. This is a chart, again, going back to the 80s, aerospace and defense sector. What this first red blurb, that big red candle, and keep in mind, these are monthly candlesticks. So every candlestick equals 1 month of trading price action. And also note that I feel it is imperative, and I cannot emphasize this enough if you're new to investing, or whether you've been doing this a while or not, especially technical analysis charting, is to use log scaling when you are looking at long-term charts. We're looking at a chart here spanning decades. So therefore, the price swings, when you go from $80 to $100, that's over a 20% gain. But when you go, when you gain 20 points on a 2,000 point index, it's immeasurable. And here's the difference. If you're using arithmetic or AKA linear scaling, this is what it looks like. It's a completely distorted technical picture. You cannot draw these trend lines because a 35% drop back here in the 90s is immeasurable. You can't even make it out with the human eye. And so again, I feel it's very important to use log scaling. All right, let's get off that. All my long-term charts and most of my charts, except the shortest intraday charts, are usually log scaling. Anyways, here's what we're looking at. You can see, first and foremost, what stands out. I've drawn trend lines. The aerospace and defense sector, like most other sectors, we have bull trends, uptrends, and downtrends, and those trends are sometimes better defined than others. Here's a very well-defined uptrend line right here. This was leading up to the last bear market, the highs in late 2007, and you can see a lot of reactions, then a breakdown. So, and I also went through and I measured out each of those declines, each of those bear markets, and as you can see here, 35%, 49%, 33, 43, 62. All right, so we're coming up with an average somewhere in there. Let's just call it 50. I don't have to do the math, but you can see. Also keep in mind, this is a secular bull market throughout there. If and when we enter the next secular bear market, it's not going to be pretty. But I just wanted to kind of put in perspective just how far and how long this run has gone. In fact, the closest the closest run that we've had to this, if I look at back here in the late 80s, and this at the time was the biggest bull market in history. Now we're challenging that one with this bull market. And I just want to show you something real quick that stands out to me. What I did earlier is I took a point measured from lows to highs on that bull market run. Again, I'm excluding this. There was technically a bear market. That drop, I forget, I just had it pointed out 35% or so. But you can see for the most part, this that was quick. It was a 1 month. It almost looked like that Black Monday. The Black Monday was when the Dow dropped over 20% back in 1987. Um, but you look at the trend line, and I like to do this at times. And again, you have to do this with log scaling. It will not work if you're not using log scaling. So log scaling puts the moves in equal percentage terms, not dollar terms. That's what it's all about. So if I take that line and move it over to the last bear market low, so in other words, the beginning of this bull market, look how perfect it lines up. Again, I had this trend line here on this chart. This blue trend line here, I'll show it to you this way again. Let's just draw that same line right here. There it is. There was that bull market, longest in history. And here's the current uptrend line. This is the primary uptrend line. They mirror each other. Coincidence? Yeah, maybe. What does it mean? Well, first of all, I had only done that after the fact. I added that trend line. So let's just take it away. I just want to point that out. Oh, and by the way, what that does is it tells me in a quick visual the distance of the line, in other words, let's draw it out here, from this point to this point, that's time. That's an equal amount of time. So we know, remember, this was that those trend lines mirrored each other to the penny. And the distance from the bottom and up, in other words, the y-axis, you have your x and y-axis, tells you how far in percentage terms. So you can see that this bull market has just eked out in percentage terms, but we're actually higher. We're higher right now. We're well above this trend line. And at the very least, I think we're coming back in to test that trend line. And if you want to know my opinion from looking at this chart, looking at everything else, knowing where we are in the business cycle, this huge bubble the Fed inflated, I think we'll eventually take this out. But even if we just get there, and believe me, that would be my first target, where most likely if I am short the transportation or the defense stocks at the time I'll cover, you're talking about 22, greater than 20% just to that level. Okay, the other thing that stands out on this chart is, as I often say, divergences aren't a buy and sell signal. Overbought's not a buy signal by itself. But what I like to do is combine things, and my favorite is to combine trend lines, well-defined trend line breaks of support, with other sell signals or buy signals if it's in reverse. And in this case, you can see I've circled every time we had a well-defined uptrend line. That trend line broke, there was impulsive selling, and it was followed with a bearish crossover on the PPO. Now again, we're talking a monthly chart here. There's not a lot. I could put up the histogram. That's not, by the way, this is a rate of change 12. I use this as a trend indicator on monthly charts for the market and some other things. But I circled them there, and you can see the PPO works very well as a trend indicator on just about any time frame. When the PPO line, in this case it's blue, is above the signal line, which is a white line, the trend is bullish, and vice versa. And the rate of change also helps define those trends. You can see the bull and bear market. So there it is. So we have pretty much two check boxes, if you will. And right now, this one's still pending. We need to see a break and a monthly close. I cannot emphasize that enough. We need to close below this trend line. I'll zoom in real quick. There it is. Lots of reactions, well defined. We need to close. There is an intra-month break, but we close back above trend. So keep an eye here. This paints a longer term picture. Now, based on the posture of that PPO, I think it's inevitable from this point. I think it'll happen within the next month to 3 months. Looks like we're getting a PPO cross there, and they're pretty darn effective. Again, go back on your own charts. So there it is. That would be, again, my minimum target, but this is our bull market uptrend line. And if sooner or later this one will be broken, and then you're talking, probably a lot more than a 22% drop, whatever it was I just showed you a minute ago. In fact, I think we'd come back down here to about the 1340 level on that sector. And from the recent highs, that would constitute a drop of about, there it is, 52%. So right about where I said in the range there. So again, I spent a lot of time talking on this because I'm trying to paint the bigger picture and show you these charts, they're very clear. These trend lines are clear. These patterns of bearish crossovers on the PPO, as well as the bullish crossovers that get you in long. If I wanted to right now, if we were coming off a 50% drop in a multi-year bear market, I would be drawing the trend lines in reverse. I'd be showing you downtrend lines. I'd be showing you bullish crossovers and other things to get ready to position there. So enough on that. I know I covered that in detail there. I just wanted to kind of hammer in the longer term implications there. All right, so ITA, wrong one, I did IYT. ITA, here's the weekly chart of ITA, which is the ETF. This is our trade idea right now. iShares Dow Jones US Aerospace and Defense Index Fund ETF. There's a few out there. I covered that in the last video. XAR, PPA, you can trade any one you want, but this is the one that we're using as the official trade idea. And when we zoom in here, you can see a very well-defined trend line, lots of reactions on it. And again, and when I'm drawing trend lines, the more reactions, the more valid that is, the more significant that support level is. And then once it's broken, and you see here we had impulsive selling, we broke down, and we've been back testing for a few weeks, and we're starting to roll over. So this trade still looks good and has, again, a lot of potential if we want to swing this one down. That's why I have this potential long-term target zone. I may make this the official trade idea. So here's a daily chart I jumped over to, and you can see this even goes, that trend line goes to the left of the chart. The trend line starts in early 2016. Let's zoom back in here. Divergent high. We broke down. We back tested, as I said, for a few weeks here, and we're starting to roll over. So this is the first target, 184.90. And again, I'll most likely add additional targets. I'll tell you that right now. If I don't get around to it and you're willing to ride out a reaction here, I do expect a reaction off that level, meaning a bounce and or consolidation, probably a little bounce, a little both, and then a continued move lower. I do have a pretty high degree of confidence these targets will be hit if you're willing to tuck this one away. And what that means is obviously keep your stops in place. Trail stops down. If we hit the first target, you should lower your stops at least to entry at that point. I don't always make mention of that. Sometimes when updating a trade, if it has multiple targets, I'll say that. Consider lowering stops, taking partial profits when a target is hit. All right, so there's ITA, and just to go back to look at a few of these individual stocks, what they've done recently. Here's Boeing. We already had a divergent high right here. I don't know why it's listed there twice. Oh, I guess, yeah, because we have another divergent high. That's what it is. All right, so we have divergent high 1 back there, 16% drop, divergent high 2, an extension of the existing divergences. PPO is now pointing down, the RSI is pointing lower. In my opinion, this stock is going lower, and it will take out that 317.32 level. That's your next sell signal, and I don't see anything slowing it down. Maybe a little bit of support right there around 295, but come on down here at about 268, I think, before the first significant reaction. So there's Boeing, UTX. Again, these charts are weak. They're not like the semis and tech and everything and that's a whole nother thing. We'll get into that soon. I think that'll be another great short and put it away sector. Short it and forget it. And again, metaphorically speaking, always use your stops. Don't just forget it. But if you put a stop in place, you can forget it. That's the beauty of it. I talk about the OCO orders. One cancels another. Set your profit target. Set your stop. Set it good to cancel so that order stays out there, and let the position play out. So here's Boeing, Lockheed Martin, LMT. This was one of my favorites in the video, and I gave targets at the time and pointed out during that video that I thought it was a great shorting op as it was backtesting. It was either here or here. I think on this one, backtesting that resistance level. And since then, it's already fallen, hit my first target, and it's close to the second target now for a drop of about... So far, about 6.5%. So nothing stellar, but consider in an upward market. That's the thing. So when we're looking at another point I just made is these stocks have relative weakness against a broad market. That's not a good sign. You want to short what's weak and buy what's strong. Anyways, there's LMT. We'll just go over a few more and then jump out to the long-term charts and wrap it up. I do want to show you a few things on these individual stocks. GD, General Dynamics, very nice, well-defined support zone. You can see a lot of reactions going back here to, 2017, early 2017. That was resistance. We broke out and then back tested it since, and it's flirting with the bottom of that support zone right now. So a lot of thin air under GD if that one goes. And the divergent high, was a precursor to that drop. There it is. We put in a divergent high, and this stock fell about 16% in short order, hit support, had a muted bounce, a dead cat bounce, if you will, and we're already back on that support. If these stocks were in a strong bull market and going a lot higher, the buyers would have stepped in here and bought aggressively, and they haven't done that right now. But Like I say, support is support unless broken. So you don't short GD right here at 192.74. You wait till it takes out this recent low or moves a little bit lower. You'll know it when you see it. There'll be a big red candle. The sellers will step in. When this level goes with conviction, you're going to see all the stops on the longs start to get hit. Shorts will pile in, and you'll probably most likely see some impulsive red selling. Now, if the market holds up by chance, S&P 500, you'll probably see a breakdown, maybe it's impulsive, and then come in and back test. So there's your second objective short entry. You either short on the breakdown. You don't always get a back test. That's why, otherwise I would say wait for a back test if we knew we'd get it. We don't. A lot depends on the broad market. I'm also looking at one thing here as well that's going to give me pause on GD as I point this out. If we get that scenario, breakdown, and we could go up, we have potential positive divergence forming here. So may want to hold off on that one for now and see what happens. But again, overall, the sector looks bearish. So I think if we get a bounce, especially if those divergences start to play out and then fail, that would also show us that a change of character. During a bull market, bullish divergences on the daily time frame on a stock that's in a primary uptrend like this, very strong uptrend, well, that's a great buying opportunity. However, if these divergences form, we pop to a new low, we start to kick back a little, and these bullish divergences form, but then the stock burns through those divergences, very bearish, because that is bear market action where bullish chart patterns and bullish divergences fail to play out or only play out for a little bounce. Just like in a strong bull market, those bearish chart patterns and bearish divergences tend to not play out nearly as well as they do in a bear market. All right, so a couple more and we will wrap up. RTN just broke trendline support here. Had a little whipsaw signal there, got back above, but now it's broken. Moving down, it's taken out the 200-day moving average today, exponential moving average. NOC, Grumman, excuse me. Little tongue twister there. Nice trend line, and it's starting to crack below after. Again, these stocks had a little false breakdown recently. A lot of them did jump back above, but they're breaking down again. That's bearish. When you have a false breakdown in a bull market, a failed breakdown is usually what we call a bear trap. The shorts jump in, then they get squeezed out, longs pile in. That's not the case here. You should have saw more follow through if the stock was going higher. Instead, we regained that trend line and started trading sideways, and we've already now broken it again. So I think these guys are going lower. Just my 2 cents. COL, Rockwell Collins. Now let's just look at these same stocks again on a weekly time frame. There's Boeing, negative divergence. What I'm doing here is taking a top-down approach on these stocks from a technical perspective, charting perspective. Yes, I just went from a daily chart back, and we're working our way back now to the monthly charts, but it's these monthly and weekly charts that formulate the bigger picture. So in other words, we're not swinging, not trying to swing for a 5-10% quick short trade and get out. The potential is in these charts for trades, profits that measure well into the double digits. So here's Boeing, negative divergence, rising wedge, and we just needed to crack below there. There's UTX, United Technology. You can see on this weekly chart, I've drawn all these trend lines. You can see after the trend line breaks, there's usually corrections. And this weekly chart, by the way, is 10 years. LMT, Lockheed Martin, as I mentioned in the video, one of my favorites at the time, already down below trend with that impulsive selling right there, impulsive red candle. GD is cracking below trend. You can see nice, well-defined trend line on GD. General Dynamics. Here's Raytheon. Also starting to crack below trend. So there it is. This is what I like to do. I like to not just find a sector ETF and base my trades only off that chart. I like to drill down, and if I didn't mention it before, guys, I'm going through, I have the components of ITA sorted by market cap. So Boeing's the biggest at 208 billion, then UTX at 101 billion or so, almost 102. Lockheed Martin's at 88. And that's all I'm doing here is going through the top components because these make up the bulk of the returns of the sector. And these are also the leading companies, hence their market cap is the largest. So if these leaders go down, you can be rest assured the majority of the other stocks in the sector are going down with it. All right, so one more on the weekly. Nope, I don't have anything there. All right, we're going to wrap this video up here looking at the monthly chart. So we started out with a monthly chart of the sector, and I'm just going through those top half dozen or so leading names on a monthly chart now. Again, this chart goes back to the mid 80s here. This is 1984. You have a trend line going up. And although I didn't measure it out in Boeing, same story. And you get more bang for your buck trading individual stocks, whether it's long or short. If you pick the most bullish stocks in a bull market, the most bullish setups, you tend to outperform the sector, and vice versa on the downside. If you can pick the most bearish looking stocks, you tend to outperform in a bear market. And it's simple because when you go with the sector, it's like it is almost like a mutual fund. You have a basket of stocks, and you're going to have some good ones in there that hold up the bad, offset the losses in the bad, and vice versa in a bear market or bull market. So there it is, and you can see these returns they're running about 50%. I'm dragging. I don't know if I pointed it out. See the pop-up box to the left. Look at the red, the numbers in red down on the bottom, on the right, that's 45.31%. And again, I'm just clicking at the top where those corrections started, going to the bottom, 64%. So you get the picture. And, I know I'm repeating a lot of the same things here, but I'm trying to impress the point. These are big drops we're looking at when these trend line breaks. And these are clear trend lines. So I didn't try to force anything here. I went in, these are trends that stand out clearly. This one was a correction. Here's one of those that was a correction more in time than in price. We had several years, looks about 3 years or so. These are year break marks down here of sideways trading action after that trend. So, if you shorted, you didn't lose anything, but you also didn't make anything. And you've got out, if you were long, you got out and you avoided a frustrating dead money trade. So again, and that's rare. Usually you get the trend line breaks. You might have some consolidation or a little kickback. You can see a lot of the times, not always, we didn't kick back and hit the wedge here. We didn't do it here. Sometimes you have a little kickback rally. We had one here that lasted for, over a year. That's rare, but it does happen. And so here we are, guys. Again, this is Boeing, the largest component of the aerospace and defense sector. And what stands out to me is we are right on trendline support. We're still above it, but I can see the indicators. The momentum indicators are turning down. Here's the PPO. I'm sure the RSI is also turning it down. I don't have it here on my monthly chart right now. It's not up. UTX. Here's a stock. I pointed out a different pattern. This one has this pattern of these wedges. You can see here a rising wedge pattern. And another point that I should add to that, to this video in these stocks, is a lot of times when you have a very long in the tooth, an extended uptrend, bullishness is at its extremes, at the top, just like right now in the market. Everyone thinks this market cannot go down. The Fed's not going to let it go down. It's going to go up forever. When that bubble finally pops and when everyone sees, for whatever reason, when everyone sees the same thing and they decide it's time to exit, it can happen very fast, as it did here. Remember, these are monthly candlesticks. That drop right there, I mean, here's 1 month. I'm going to grab the top of that candle. In 1 month, this stock dropped 40%. All right, so these are big drops here, and this is the top back here. This from highs to low measured about 54% or so. You get the picture. They're all well into the double digits, almost 30% there. And now what stands out to me on UTX is, we have these smaller wedge patterns right here, but this time, every other time we broke down from one of these primary uptrend lines and we had a bear market in that stock, it was really a correction within this larger secular bull market. And you can see that what it did here, it brought us back to this primary trend. This is our secular bull market trend line right here. This was a period of sideways price action in UTX for in the 80s and up to the mid 90s, and then we really took off. And yes, the trend was up, but you can see there's a pretty well-defined trend line now. So my point is, when we break this wedge now, here's the bottom line to the current wedge, which is also the same as the long-term primary, multi-decade trend line. So when this wedge breaks, it's going to have longer term bearish implications. It's going to put us below this secular bull market uptrend line, and that could set the way for a secular bear market. I do believe that's coming. A lot like Japan had when they went to a zero interest rate policy back in the 90s, and they had the decade, or really they call it, it was 2 decades of stagnant growth and bear market in the Nikkei. So Just trying to paint the big picture here. And again, we're walking on the lines now, and it could be months more, but we're starting to get some of these big ones cracking already, like LMT, the Lockheed Martin again. Breakdown. This time it back tested. No back test here. No back test there. Will we back test? Maybe, maybe not. But I'll also point out there's big divergence. A lot of these other tops, you didn't have this kind of divergence that we have right now. This is big time clear negative divergences. And I threw up the RSI. If I throw it up on there, you'll see the same thing. We have the divergence on the RSI as well. Let's park that RSI, put it back. All right, and we'll wrap up here. I don't have much on GDN. There's Raytheon. There's a trend line. Just jumps out to me, and these are very clear trend lines. I don't need to study that chart very long to draw that trend line. Here's another one back here, and that's it, guys. NOC already had the lines marked up. So again, going back to the mid 80s, and you can see these are big drops. 76%. Roughly, I'm just doing the quick math here, 71 or plus. Even this little drop here back in 2000 to 2003 or so, that was a 38, almost a 40% drop. Here was the bull market top in 2007 from the highs down to the lows. That was about a 63% correction. And again, this trend line right here, the only comparable trend that was so strong was this one back here in the 90s. And again, due to those excesses, that was followed by a 70% correction. There isn't a single reason why I don't think, in fact, this one has the potential to be worse, in my opinion. The excesses the Fed has created in this market, valuations, and most importantly, they don't have any silver bullets anymore. When, during the financial crisis, 2007, they had a lot of room to lower rates, and they did. They brought them down to zero and went to the zero interest rate policy. Yeah, they backed themselves out of that corner a little bit, but not nearly as much. Even though they've been hiking, they have very little downside. So that's it. We'll leave it here, and again, we'll look at the daily charts in the 60 minutes to kind of hone in. And when we go back to ITA, here's where we're at right now. There's a little bit of support right about where we're at, but I don't see anything stopping this one until it gets down to the first target. And we've already back tested the trend line, rolled over. Ideally, I don't want to see another back test. And look, if they take us out on the stop, so be it. That's trading 101. You just have to have the stops. And I know we've had quite a few trades this year just barely hit the stops and go on to play out, but I don't see any reason to modify this trading plan at this time. So we're going to leave that in place, and I'll keep you updated if any developments occur that I notice. And also, if I decide to extend this target, I'll do so. This is kind of a longer term area. You can see down here 124.39. That's about a 36% drop. So if you want to know right now where I think this one's going before all said and done, that's it. About another 36% from where we're at. Be a little more off the highs, probably about 40+%. All right, this has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.